Hello, measurement principle. The measurement principle says that we are going to measure things based on cost. That may seem straightforward, but there are a couple confusing issues on it. For example, if we were to purchase a building and we purchased it today for $100,000, then that's pretty straightforward. We would put it on the books at cost at $100,000. Not a big problem there. However, you might ask, well, what if we financed the building? What if we put it on the books, or what if we bought it for $100,000 but we financed 80 of it and we only put down 20? We're still going to put it on the books at the cost, the full $100,000, even though we didn't pay for it all in cash. We still paid for it basically with a loan. We're responsible for the loan, therefore we're still going to record the cost of the building at the $100,000. You might then ask that, well, what if we got an appraisal on the building and the appraisal is separate or different than $100,000 and we still bought it for $100,000 at this point in time? Well, in that case, we're still going to go by the cost that we purchased it for. And the reason is that because on a free market, we assume that the best indicator of what the cost of something like a building is having it on a free market and having it sell for something. That means that the seller and the buyer agreed on a price in a free market. As long as they're not related and they're both out for their self-interest in a free market and not coerced to do so, then that means that that is the fair market value. That's the definition of the fair market value. That's the best measurement we can have. Now, there is a factor like, what about later on? What about like 5 years later and the fair market value is going to change, isn't it? Well, we're going to basically adjust the cost in terms of depreciation. And there is an argument to say, well, we should appraise it basically later on at a different point in time. We're reluctant to do that in terms of something like a building. And a few reasons are that one is that there's going to be fluctuations in the market. So the market could go up and it could go down. And the assumption is that the cost and the adjusted cost is going to be more accurate in relation to those fluctuations. And the other is that we really don't know what the cost of a building is after the purchase price, because it's a unique thing. So unless it actually sold on the free market, it's really hard for us to actually determine the cost of it at any given time. We could try, we can appraise it, but we still tend to want to keep it at the adjusted cost. Next principle, we have the going concern assumption. Again, seems very basic. The going concern assumption means that we expect the company to keep going, meaning we expect the company to keep going and stay in business for a long period of time. Now, why is this important? It is really important that it is a going concern. Note that if a business is not a going concern, meaning if they expect to go out of business, then their incentives to do things differ greatly. So if they are a going concern, they have incentive to build trust in the community and build a good reputation. If they're thinking that they're going to leave in a month and they're going to be out of here, note that their incentives are a lot different. Their incentives could be to make money in the short run at the expense of their reputation and then leave. That's a huge difference in incentives. So if we have some company that we assume is not in business for a going concern, it's not that it's a scam in that case, but scams do have that in common. A scam is generally something that people go in and they're in the short term, they're going to kind of ruin their reputation and make money at the same time and then leave. or if a business goes out of business, again, the objectives of the business just change. If a business is in it for the long haul, then they have an incentive to do well in the community and establish themselves in the community.